welcome to the second session of the OITI Webinar Series titled Digital Service Taxes, Temporary or Permanent Measures. Digital service taxes has become one of the most controversial tools in global tax policy, bringing gaps in digital taxation while deepening geopolitical and legal tensions. Please note that this webinar is being streamed live on Facebook. So for this webinar, we are pleased to be joined by Leonardo Pignatari, PhD candidate in tax law at USP and senior manager for international tax at KPMG Brazil, as today's speaker, and also by Andrés Baez, senior researcher at the Max Planck Institute for Tax Law and Public Finance, as discussant. Please feel free to submit your questions in the chat. We will bring some of them in the conversation later, and also we will open the discussion after the interventions. So, Leonardo, the floor is yours, and thank you for accepting our invitation.
Thanks a lot, Manuela. Good morning, good afternoon to everyone. Thanks to the Observatorio for inviting me to join this webinar. Thanks to Professor Andrés as well for joining me in this exciting discussion. I'm going to share my screen. I have prepared a presentation so we can go through some points. And of course, Andrés, feel free to intercede, to intervene, to make some comments during my presentation. Let's make something more open. Okay, here we go. Can you see my screen? Because I cannot see you, so.
Yes, you can. Yeah. I can.
Oh, good. Okay. So our talk today is digital service tax, whether they are temporary or permanent measures. And it's a very good timing to discuss such a topic because we have been facing a lot of challenges due to the new U.S. policy, trade and tax policy, and this kind of taxes may face some difficulties, or maybe they can like fight back and stay. This is the agenda that I prepared for today. So I believe that it's good that we have a very brief background on the discussion. Then we go through the digital service tax. What are digital service tax? What is their nature? Later, what is the interaction with double tax treaties? The fourth point, we are going to talk about the DSTs on the verge of what's going to happen with DSTs, what we are seeing basically in this first 5 months of 2025, and finally some food for thought so we can start our discussions and of course address the questions from the audience. Let's go. The background. Very, very quickly, just to put everyone on the same page. Where did this discussion start? With the idea of businesses with a decentralized value.
Hi, sorry to interrupt you, but at least for me, the screen I see is not the actual presentation, but only your slides is not in presentation mode. So I can see your,
no.
Yeah.
So let me stop here. Let me try again. Is it good now?
It could be because I'm on my phone. I don't know what others see, but I don't see presentation mode. I see, the slides where you can add it.
Yeah, I'm also seeing slide by slide, like if I were myself doing the PPT in my computer. I think that you should go to this presentation mode down. As if you were projecting that for your students in a classroom.
Yeah. I believe that's because of my computer has some. Let me try again. What about now?
Now I'm seeing that in presentation mode.
That's
Ivan,
good.
are you see?
Yeah,
It's okay?
yeah. Now it's okay for me too. Thank you.
Good.
Okay, thanks. Thanks a lot. Sorry. So here we go. Some quick background. So where did this discussion start of how to tax the digital economy? Because certain businesses have a decentralized value creation and lack of physical presence. There is no need of physical presence to exercise their economic activities. And this is not a new discussion. The OECD started kind of the discussion in the OECD Harmful Tax Competition report in 1998, followed by other reports, such as the Ottawa Conference report, A Borderless World, Realizing the Potential of Global Electronic Commerce. And later, in 2014, are the current treaty rules for taxing business profits appropriate for e-commerce? Back then, there was already a discussion on how to tax the digital economy. Of course, it was focused on e-commerce, not on Facebook, not on Instagram, because they did not exist back then. But we had already had a discussion on nexus, new nexus for taxing those kind of businesses. Later, this discussion gained a lot of force due to political pressure, pressure from the public, with the feeling that the big companies did not pay their fair share of taxes. So we had the well-known BEPS project with its 15 actions. For us, what matters is Action 1, which deals with taxing the digital economy. And there was a very strong concept of value creation. So we should tax or we should allocate taxing rights to the jurisdiction where value is created by the users. However, when we look at the unified approach, BEPS 2.0, with Pillar 1 and Pillar 2, we still have this kind of rationale, but without the name of value creation. If we put a Control plus F in the documents of the OECD after 2019, we cannot find the word value, the expression value creation. But it's kind of there, especially in Pillar 1. Pillar 2 is quite advanced, as we know. Pillar 1 is facing a lot of technical and political and many problems already, but Pillar 2, for instance, in Brazil, we have introduced Pillar 2 as from this year. So it's going okay. Then 2021, this statement is important because in October 2021, the OECD and the G20 Inclusive Framework Statement said that the countries, 140 something countries, achieved an agreement on a global solution. But this agreement was an agreement to agree that if we agree with these solutions, we are going to follow a common approach. So there was no consensus, international consensus in 2021, as initially someone could imagine.
Sorry, Leonardo, I raised my hand because you know I totally share your approach and kind of trying to look for the historical roots, but I think there is something that you have mentioned, but that should be stressed. And this is the fact that even if the OECD started abhorring all these digital service taxes as soon as 2018 in the intermediate report, this was generated by the final report on BEPS Action 1. I mean, now it looks like, well, 10 years ago and quite old thing, but if we reread this BEPS Action 1 final report, we see that now the OECD is saying that they never endorsed this, that they didn't like it, but actually what was said there is that for all those problems that were not that were addressed but not resolved in the report, there were three solutions: virtual PE, withholding taxes, and then what they called in the time equalization levies. And they called them equalization levies because that was the name that was used in India, that was kind of the first mover in this field. So I always tell my students that abhorring later on those countries that have introduced a DST, saying we never pretended this, we never proposed this, we never wrote this, is like, you know, inviting your friend for a coffee at home and then calling the police and saying you have an intruder at home. Actually, it was the final report on BEPS Action 1 that proposed this as a possible solution. Of course, it didn't endorse it, but it was there, and it was logical for the countries to move in that direction. That was just something I wanted to add to your very good historical approach to all these things.
Exactly. So the OECD did not make a recommendation, express recommendation back then, but they raised some alternatives, which later digital service tax got inspired from. So meanwhile, like some countries try to wait for global consensus, and even some international organizations started, or regional organizations started to think how to approach the taxation of digital economy. So, for instance, in 2018, the European Commission proposed a digital service tax. As you might know, for tax matters in the EU, you need unanimity. They didn't get this unanimous decision to proceed with a digital service tax, but ironically, it inspired other countries, as we are going to see later, to introduce its own digital service tax, such as France, Italy, UK. The ATAF, with the African Tax Administrative Forum, also have issued some guidelines to African countries willing to introduce a digital service tax. These guidances were back in 2020 and last year as well. And of course, we should mention two important events from the US side, which is the US reaction from its trade representative, and the kind of statement between US, Italy, Austria, Turkey, and other countries on a provisional credit. This idea was the fact that when Pillar 1 gets in force, then the companies that paid digital service tax in Austria, India would have a credit on the amount A. But this was merely a political statement, and digital service tax have been collected in the meantime. Also, I believe it's worth mentioning the July 2023 statement of the OECD, when they said, okay, if we get the signatures for the multilateral convention Mount A, we will have like standstill of newly enacted DSTs. But the threshold that the statement provided was too high that the only possibility to have a standstill for the newly enacted DSTs was if the US signed it. And the US did not sign it. Interesting enough, Canada, which is a member of G7, did not sign this statement. And they have introduced recently a DST. There are other unilateral measures. Here it's very important. We are going to discuss a bit later, but some people make a confusion between DSTs and diverted profit tax, virtual PE, VAT. They put everything in the same basket as it were digital service taxes. However, there are different approaches to taxing the digital economy. Digital service tax is one of them, but there are several others which have been introduced by different countries in the past couple of years. For instance, virtual PE, current system modifications, withholding taxes, VAT. So it's important to address that these other measures are not digital service taxes. And of course, the UN got into the discussion and introduced Article 12B in the Model Convention 2021. And currently, we have a discussion of a new provision in the UN tax model, which is Article 12AA, which would kind of a mix between Articles 12A and 12B and Article 14. So you would have a broad taxation of service under 12AA. But it's quite controversial, and there are still ongoing discussions on this provision.
Leonardo, sorry again, sure. I raised my hand again, and I wanted just to...
And Andrés, please, just intervene, because I cannot see your hand
okay,
here.
Okay, perfect. You're right.
I cannot see your faces. Right. So please, just jump in.
Good. No, I wanted again just to add something very, very specific to your explanation. Can you go back to the previous slide when you had all the UN history? I mean, there is a part of the story here that is not in your slide, and this is the original Article 12A. I mean, the original Article 12A introduced in the UN model in 2017 on technical services that could be taxed at source in the absence of a PE and physical presence could have been also an instrument, combined, of course, with domestic law, to face the challenges of the digital economy with a lot of problems that we all know, withholding taxes, blah, blah, blah. But it was the UN that decided that this Article 12A was not going to be a proper instrument for particularly the big part of the pie, which is automated services, digital advertising and digital intermediation, essentially, which is the real beef in this whole thing. And they did that by ways of the commentary saying that automatic digital services were not technical services, so we're out of the scope of Article 12A. You have, Leonardo, yourself written about this very well in the past, so you know the story I'm talking about. But I think that then if we start with 12B that was introduced 2021 to deal with automated digital services, originated by the fact that 12A was not able to cover these services, then we understand the whole story. But then later on, the UN understands the mistake they had done. They had originally a 12A that could cover everything. They decided to restrain it, so they didn't, or they needed 12B. So they said, well, why not having just one? And this is the whole story with this thing called now 12AA, or just 12A, I would say, in which they want to cover everything. And then you would say, well, then everything will mean that 12A, all 12A will disappear, 12B will disappear, and 14 will disappear. That would be the logical approach. Surprise, surprise, it's not the approach. Now we will live in a world in which we have 12A for services and 12B for automated digital services, which doesn't make any sense whatsoever. I mean, that's a really bad idea. But anyway, I just wanted to give some context. These are not digital service taxes. These are withholding taxes, I guess, or income taxes. I guess later on we will talk in detail about the distinction between these two these two groups. But anyway, just to add something to your historical approach again.
Totally agree, Andrés. Yes, this historical approach is very important to understand to where we are going and how to interrupt this many alternatives that we have for taxing the digital economy. It's always good to bring my own landscape. Of course, these news are in Portuguese. I'm going to translate for you all, but the fact is that government is planning to send a proposal for taxing big tax. Big tax must be for a second moment. Taxation of big tax come back to discussion by the government in the middle of a clash with Facebook, with Meta. This news shows that the Brazilian government goes and changes its position constantly. These are news from the second semester of 2024 and the first semester of 2025. So in Brazil, we have an ongoing discussion whether to tax big techs, and I'm going to show some examples of what Brazil is proposing. But the thing is that this is under the table of the federal government, and of course, a political element is always involved in this kind of discussions. Okay, so with this quick background, I think we can go to the heart of our webinar, which is understanding what digital service taxes are. So they are unilateral measures for taxing the digital economy. And normally there are 5 categories for taxing the digital economy. We have the DPT, diverted profit tax, which was introduced in the UK, in Australia. We have the equalization levy in India, and we are going to quickly go through the Indian equalization levy, the adaptations of the current system. We have PE, and finally DSTs. So what are DSTs, digital service taxes? They are founded on the idea of value creation, which in my opinion, is a very controversial nexus for taxation, because value creation is highly subjective, and you may have an active value creation, you may have a passive value creation, and how to measure it is completely difficult. Therefore, there is a lack of a clear and uniform concept on whether digital service taxes are. Even when we qualify an alternative as a digital service taxes, there are a lot of difference between them, and that brings fragmentation, legal uncertainty, all the features that we would not like to see in the international tax system. DSTs normally have a restrictive scope. They are focused on services that have the user value creation as their core, their business core. They have a hybrid nature. They are kind of in the middle of income tax and consumption tax. And they adopt monetary thresholds for establishing who is the taxpayer. There are a lot of compliance burdens. We are going to go through some examples, and these compliance burdens will become clear, but it's not easy to apply digital service tax when we have monetary thresholds, global monetary thresholds, and local thresholds, and some general features of DSTs. They are levied on gross revenues derived from certain services. There is no deduction of expenses, no credit, and they are applicable to domestic and cross-border services. Here, I believe it's worth mentioning the Multilateral Convention on Mount A, because it provides removal of DSTs and other relevant similar measures under Article 38 of the MLSC. But the most important thing is that the Multilateral Convention on Mount A provides a definition of DST. And under this definition, we have 4 main features. The first one is a reference to the place of consumers or users. The second is that DSTs are taxes focused on non-resident or foreign-owned companies. Third, DSTs establish revenue thresholds. And finally, they are clearly out of the double tax treaty objective scope. This last feature is quite controversial. I have written my master's on the interaction between Article 2 and DSTs. And depending on which DST we're talking about, we might be under the scope of the treaty, even though it's considered a DST. Interesting enough, the Multilateral Convention on Amount A establishes an express exclusion from the concept of DSTs for DPT, VAT, transactional taxes. Therefore, the OECD itself recognizes that digital service tax do not cover all the alternatives for taxing the digital economy, but they have special features that should be taken into account. And the consequence of having a DST in your jurisdiction is that no amount A allocation for this jurisdiction. Just for
Leonardo, just another thing again on withholding taxes in this context. Even if, and this was kind of a big discussion, what would happen with withholding taxes in the context of amount A, and even if there was no direct exclusion or direct inclusion in the concept of DSTs, so it was never said that withholding taxes were considered DSTs. This would have been too much. But in the calculation of amount A, all withholding taxes would be taken into account under this strange thing of double counting and correcting the double counting. So if you had withholding taxes and you had been fortunate or let's say skilled enough to have them in your treaties, this would count to 0 under amount A, because once you have calculated amount A, somehow you will deduct of the withholding taxes that you already had, not only on services, but also on royalties. So, I mean, the final outcome was exactly the same as if they had gone to say, well, whatever unilateral measures that are called DSTs or withholding taxes will somehow reduce your amount A, which I think is one of the biggest elements of disappointment for developing countries with amount A, one of, okay, because there are so many that they are actually very difficult to count. Just an addition. And I have a question for you. Before you mentioned that there are different kinds of, can you go back to the previous slide, please? You mentioned 5 categories or unilateral measures for taxing the digital economy, and one of those categories is equalization levy and the other is DSTs. Which is the difference between an equalization levy or the original Indian equalization levy and those proposed in BEPS Section 1 and what we have been witnessing as DSTs? Because I don't see any.
This is a very good question, Andres. Here is the 5 categories that normally we see scholars talking about. In my thesis, for instance, in my master thesis, I consider equalization levy, the Indian equalization levy, as a DST. We are going to go through the Indian model, and I treat the Indian equalization levy as an Indian DST.
Perfect.
There are some difference because we have the equalization 1.0 and we have the Indian equalization 2.0. The first version of the Indian equalization levy resembles a withholding tax, but the equalization levy 2.0 is an European DST. It's very similar to the European DST.
Good, thank you.
Thank you, Andres. Here is just to have an overview of how many countries introduced it or are planning to do it, to introduce a DST. Of course, this changes a lot. Political agreements are made between. So just to have a high level idea of how digital service tax have been dealt throughout along the world. At least 24 countries introduced DSTs. For instance, I think the biggest example, Canada, which is a member of G7. We have Colombia. Colombia has a significant economic presence and a kind of DST. India, we are going to go through India in a bit. Kenya is interesting enough because Kenya has replaced its DST with a significant economic presence rule in December 2024. So a couple of months ago, Kenya has abolished its DST and introduced a significant economic presence, which is kind of a adaptation of the current system, or you can think of like a sort of a permanent establishment rule. And Uganda as well. Uganda replaced a DST with a withholding tax. a flat withholding tax this year. So you see that countries are messing with the alternatives for taxing digital economies. Some of them introduced the VAT, some of them a DST, others are withholding tax, and some of them are changing their alternatives from a DST to a withholding tax or to a significant economic presence tax. Brazil, in the case of Brazil, Brazil has many proposals in the National Congress for introducing a sort of a DST, which we are in the form of CID. I don't know how much you're familiar with CID, but Brazil loves to introduce CIDs because all the revenues stay with the federal government. You do not have to share with your friends, your states and municipalities. And the latest proposal is very interesting. It's worth mentioning. It's seed detox. Seed detox is a DST whose revenues would be directed to programs related to mental health and physical health of kids and teenagers who use a lot the internet. That's why seed detox. I think it's kind of a unique name. And we believe that tax practitioners should have a detox of these kind of measures and maybe of DSTs, but that's the reality that we are living in. So that's the latest. This is the latest proposal of Brazil, seed detox. I think it was 2 months ago that they proposed it. Moving forward, now we are going to get into some of the models. The European DST, this is the European Commission model, but of course, it inspired the Italian DST, the French DST, the Austrian DST, for instance. Second, we are going to take a look at the UK model because it's a very particular model, in my opinion. And finally, the Indian DST, as Andrés mentioned, the equalization level, it's a DST. So the European DST, what we have? First, we have a 3% tax rate. It's a tax paid to the state where the user is located. The location of the user is identified through his or her IP address. The activities subject to DST are basically 3. First, placing on a digital interface of advertising targeted users, therefore digital advertising. The transmission of data collected about users, and this is important. This data transmission must be of data collected through the interaction of users, not merely, for instance, a crowdfunding. Crowdfunding is out of the scope of the European DST. And finally, the third activity is the making available to users of a multi-sided digital interface, which allows users to find others and to interact with them, and which may also facilitate the provision of goods or services. This final part is basically Amazon. You put your product in Amazon, and then you sell it to other party. It's basically this kind of platform. It does not matter who owns the platform for purpose of the application of DST. Payment or message services are not covered by this tax. For instance, WhatsApp, Gmail, Telegram, this kind of activities are not covered. The supply of digital content is not covered as well. If we think about Spotify, Netflix, their revenues are not under the scope of the European DST. However, if you have a platform that allows the sharing of digital content between the users, such as YouTube, then you are under the scope of DST. Because the idea is that in Netflix, in WhatsApp, in Spotify, the user is not the central element of their businesses. Therefore, they should not be under the scope of DST. We could question that, but that's the model, the European model. Then we have the thresholds. In the European Commission proposal, there was a global threshold of 750 million euros. and local revenues within the EU above 50 million. In France, it's interesting because the global threshold remains, but the local threshold is half of the European threshold. So basically, it could mean that the French revenues correspond to 50% of the European revenues. Then you have the Spanish threshold, the local threshold of 3 million, which is much, much less than the French one. The residence of the company is irrelevant because we are looking at the location of the user, different from what we are used to nowadays. DSTs are worried about the location of the user, not the location of the company. And a quick example here. So we have, for instance, a Brazilian national who lives in France, or she's basically just visiting Paris, and she uses her device to open an account on Tinder, a dating app, American dating app. We have a digital platform, and how would we allocate the revenues of Tinder in respect of Camila? The allocation key provided in the European model is the number of users holding an account open with a device in France. You do not need to be a French national. You do not have to be a French resident. You just have to use your device in France to open an account on Tinder. And this will be identified via IP address. Okay. For instance, if we have 10% of users in France and there is 1 billion euros of global revenues, then you should allocate 10% of 1 billion is 100 million local to France. Then 3% multiplied by 100, we have 3 million euros of DST to be collected in France. This is just a very, very high level example to illustrate how DST works. It does not matter the residence, does not matter the nationality. It matters where the user is located. And in Camila's case, where she used her device to open an account on a digital platform, such as Tinder. Okay? If you have any questions, please feel free. I cannot see the chat, neither your hands, so please feel free to interrupt me. The second model that I would like to share is the British model, because it's quite unique on certain features, and at least in my opinion, the British DST is closer to an income tax than to a consumption tax, which might lead to its coverage under double tax rates. So the UK has two main alternatives for taxing the digital economy. First, the diverted profits tax, which I'm not going to comment on because it's not our scope today. Then in 2018, they introduced the DST, and this DST has some features. First, a 2% tax rate. It's a lower tax rate than the European one. And also the scope is a bit different. 3 activities are covered. First, social media platform, which involves the sharing of content produced by the user as a significant resource of the service, Facebook, search engines, and online marketplace. And the threshold is also a bit different. We have 500 million pounds as global revenues and a local threshold of 25 million pounds. This is quite, even though there are some differences, this does not change the nature of the DST in comparison to the European one. However, there are some important particularities. First, the British DST provides an annual allowance on the first 25 million. So if you have 25 million UK revenues, you get an allowance for the first 25. Then they ask for a just and reasonable segregation of revenues. What does it mean? It means that if you have multiple activities in the UK, you have a search engine, you have a social platform, then you have to reasonably segregate these revenues for purpose of the British DST. It's a non-exhaustive list of common sources. Just for you to know that the British DST guidelines are endless. They have thousands and thousands of pages of guidance on how to apply DST. And the nexus for users are where users are normally located, or where is reasonable to assume where users are located. This is a bit different from the European model, and the problem starts here. So you might have a user with the IP address in France, but he's normally located in the UK. This different nexus might trigger a double taxation. So you might trigger a French DST because your IP address is in France, and you might trigger a British DST because normally you are located in the UK. And this is quite problematic. For this reason, the British DST provides a 50% reduction of UK revenues if the foreign user is located in a jurisdiction with a similar tax. This is a perfect example of Camila that we saw in the previous slide. So if she's located in France, and France has a DST, you would have a 50% reduction of UK revenues just to counter this potential double taxation. Another important
can I ask a question?
Sure.
It's Juliana Midori here. Just a question out of curiosity. You just mentioned the nexus requirement. And in the previous example, does it matter how long Camila would stay in France? Like how many days? Is there any guidance on that? Or just
no, there's not. There's not. No, there's not. Just the address, the IP address. So in that particular example, the allocation key is the number of users that open an account with a device located in France. So if her IP address was in France at the moment she opened her account on Tinder, then you'd have a French DST trigger.
Perfect, thanks. Yeah, there are many overlaps then.
yeah, there are a lot of problems, compliance as well, compliance problems. Another particularity of the British DST is the alternative basis of charge. We are talking about taxes levied on gross revenues. So you might have revenues, but you might not have profits. So the British DST provides an alternative basis for low margin companies or companies with loss, which is quite common in the tech world. Another feature is that they have express possibility of deduction. So you may deduct your DST for CIT purpose, provided that, of course, you comply with the CIT rules. These features are, in my opinion, quite interesting, and they distance the British DST from the European one, from the European model, historic model. And these features make, in my opinion, the British DST closer to an income tax than to turnover tax or consumption tax on the other spectrum. And they will go through a review this year.
Sorry, just to clarify, so this credit against CIT would be for domestic British corporations?
Yeah.
Okay, thank you.
Yes. So a couple of numbers, just to...
Leonardo, those I mean, domestic resident corporations paying.
Sorry?
I mean, yeah. I mean, you have just mentioned to the question of Ivan that this possibility of crediting is for those receiving the service. I mean, those resident in the UK.
Sorry,
I
cannot hear
don't.
you.
Can you hear me?
Okay, go.
Yeah.
No,
Could you
now it's
please?
better.
Yeah. Could you please explain this express possibility of deduction, corporate income tax rules? How does it work? Who makes a deduction? Under what circumstances?
For instance, this deduction, this express possibility of deduction is, for instance, if you have a British company and you have a French DST, this French DST might be used for the CIT of the British company. It's not the British DST itself. So it's a foreign DST which would be used as a deduction for the British DST. For instance, the Irish government provided some guidelines on the deduction of different DSTs. So they said, okay, for Irish CIT purpose, this list of foreign DSTs might be deducted from my CIT basis.
So it's like
that's the idea.
Like a foreign tax deduction.
Yeah, so it's not a credit; it's just a deduction.
But just for DST.
It's just a deduction.
Just a deduction. Okay, so it wouldn't be a credit under no circumstances. It's a deduction.
No, it's just a deduction.
Okay.
Yeah.
Okay.
That's the idea.
Okay.
Perfect. So a couple of numbers, because even it's quite common that some people think that DSTs are just like a theoretical discussion and they have not been collected in the past few years. So a few numbers for you. Between 2020 and 2021, the British DST collected 358 million pounds, which is 30 more than they forecasted initially. 90% of DST revenues were paid by only 5 business groups. And please do not share this information with the US, because they will take it as a discriminatory tax. DST represented 7% of the total amount of taxes paid by in-scope business groups. And here I think these 2 points, I think they are the most important ones. Half of the 18 groups that paid DST were not in the tax authority's radar. And 11 groups out of 20, which were expected to pay, did not. This is quite funny because it shows how difficult it is to interpret whether am I under the scope or out of the scope of a DST. And even the tax authorities do not know. There were some companies that paid DST without having to pay it. And there were other companies that did not pay DST but should have paid. And this shows how difficult it is not only to interpret the scope of this kind of tax, but also the compliance burden to do it. And the last feature is...
Leonardo, just a question. You said 11 groups out of 20, which were expected to pay DST, did not. That's what you have in the slide. But then you said now 11 groups that had to pay it did not. These are different statements. Which is the real one? Because it's really interesting to know whether it's one or the other. Is it that they were expected, but according to the law, they didn't have to?
They were expected by tax authorities. So these features, these numbers were taken from the National Audit Office, which is a non-profit organization in the UK, which helps the Parliament to take decisions. So the feature is not they had to pay because it's under interpretation of the DST law. But tax authorities expected that 11 groups, 20 groups were going to pay DST, and 11 did not. That's the info. And finally, most groups paid more DST than CIT. This is quite interesting. 13 out of 18 groups paid more DST than CIT between 2020 and 2021. Just because of time, I'm going to go very quick on the DST so we can address the possible questions. The Indian DST, as Andrés mentioned, the equalization level, which is a DST, has had 2 versions. First is a 6% rate over payments received by non-residents in respect of the provision of specified services, mainly online advertising. They are not applicable under 3 circumstances here. I just put for your concern, but we can move. Important thing, there is a current proposal which was approved by the lower house in India to abolish the Indian DST, the 6% equalization levy, in March 2025, 2 months ago. So it's up to the upper house now to confirm. And as far as I know, they will confirm the abolition of this Indian DST. And we have a different DST, the 2.0. The 2.0 is a 2% rate focused on e-commerce operator. It's an expansion of the first DST in India, and it has the focus on goods or services supplied or facilitated by an operator. It's also excluded in certain circumstances. For instance, the service subject to equalization levy 1.0 are not subject to equalization levy 2.0. So the Indian legislature had this concern. In 2021, there was another expansion, online sale of goods and online provision of service, which were highly criticized because it could cover traditional activities. For instance, you merely pay online, then you take you get your product in the store physically. However, this DST was removed in August 2024. So we can see that we no longer have an Indian DST 1.0 or 2.0. Okay, so the DST interaction with double tax treaties, very briefly. They use gross revenue as a proxy for income taxation. Can a gross revenue be used as a proxy for income taxation? Are these taxes covered by double tax treaties? Because if they are indirect taxes and there is a transfer of the economic burden, they should not be under the scope of tax treaties. However, it depends on which DST we are talking about. In my opinion, the British one would be covered by double tax treaties, or may be covered by double tax treaties. What matters is that the tax is levied on income, or most important, the second gateway that I call for accessing the objective scope of a treaty, which is to have a tax identical or substantially similar to an income tax. And this is the test that could apply to the British DST. Of course, we have a concern on Articles 5 and 7. Article 7, as we all know, provides an exclusive taxing right to the resident state unless there is a PE. And finally, there is a operational question, which is how to apply Article 23, a credit method, to a gross revenue tax. That's another important interaction between a DST and the treaty. Okay, here's some coming to the end, some interesting and news information for you. So, as we all know, Trump got elected and assumed the U.S. presidency, issued in these first 5 months a lot of important and controversial measures. And these measures some of them are aimed at discriminatory or extraterritorial taxes. For instance, in January 20, right after he assumed the White House, he ordered a USTR investigation on discriminatory or extraterritorial taxes. In February, they were more specific. They mentioned the Austria, Canada, France, Italy, Spain, Turkey, and UK DSTs that should be investigated and probably receive a countermeasure. And last week, we had the so-called the One Big Beautiful Bill proposed under the U.S. Congress, which is a 5% addition per year for 4 years on the US income of individuals or entities in a foreign jurisdiction with an unfair, discriminatory, or extraterritorial tax, such as UTPR or DST. So if you have a DST or UTPR, the US income of these entities might be subject to additional taxes. That's the proposal. And I think the name of the proposal is quite different. The One Big Beautiful Bill. But that's what we have currently in the US. So are DSTs at risk? As we saw, India no longer has a DST. It no longer has that previous DST of 2% abolished in August last year, and it's on the verge of abolishing its second DST as from April 2025. It might be an Indian measure or an Indian approach to get a tariff deal, but it shows how the US approach is affecting DSTs worldwide. Another example is Italy. Italy changed in the budget of 2025 its DST rules. There is no longer a local revenues threshold for Italy. So if you have 1 million euros of revenue in Italy and you comply with the global threshold, you would have to collect DST in Italy. However, the US-Italy joint statement of April this year said, we agree that a non-discriminatory environment in terms of digital service taxation is necessary to enable investments from cutting-edge tech companies. We do not know if this is an indication of Italian DST abolition, but of course it's interesting to see the next chapters of what's going to happen with the Italian DST. And finally, the British one. So they May, like 2 weeks ago, the US and the UK signed a trade deal. In this trade deal, the Prime Minister said that the British DST was safe. So the digital service tax remains unchanged as part of today's deal. However, one day after, he said, on digital service, there are ongoing discussions and very other aspects of the deal. But we do not know if actually the British DST remains unchanged as part of this trade deal with the US, or if in the next couple of months we might have another DST abolition, this time from the UK side. Okay, and just some food for thought. Will Pillar 1 come through? I think Andrés would say definitely not, and I would totally agree, especially Amount A. We clearly have a DST pandemic, and it produces a lot of challenges on DTT's applications. We may have been facing the strongest interaction between a trade war and international tax law and how they interact and impact each other. And I believe that what lies ahead for us may be DSTs with Pillar 2. However, everything lies on political reasons, and we cannot have a clear path ahead. But I believe that we shall understand DSTs. I used to say, and I joke, that DSTs are kind of that relative that we do not like, but we need to cope we need to deal with in the Sunday's lunch with the family. We do not like them. They are not that good, but we need to deal with them and learn. And that's the idea that I had for today's webinar. And I believe I could share some thoughts and some challenges that we have ahead. And of course, I'm available for any questions you may have. Thank you very much.
So please feel free. We are out of time, but feel free to open your microphone or something if you have any question, or if you want to discuss any point here. Aitor.
Yeah, thanks, Manuela. Leonardo, congratulations for the presentation. I found it very interesting, especially all this data from the UK and the new configuration of the DST. This was great. I have a question because I have the feeling that there was a topic that was not dealt with at all or very little, which is the policy debate, whether it makes sense to adopt DSTs or not. I mean, we saw a lot about the history, a lot about the design, a lot about, or also actually something about numbers, which is uncommon. And this is why I liked a lot the presentation. But my query is this, in your opinion, does it make sense that a certain type of country adopts a DST in today's economic and political scenario? And also perhaps that you contrast from a policy perspective on advantages and disadvantages of adopting DSTs versus other solutions such as Pillar 1 or versus withholding taxes, and perhaps also digital PEs like the ones adopted by Colombia or I don't remember now the African country that decided to move to that as well. So any policy remarks are very welcomed. Thank you.
Thanks a lot, Aitor. It's a pleasure to have you here. My opinion on DSTs, even though I studied and it was my master thesis, I do not like them as a policy decision. As I said at the end, I believe that they are that boring relatives or that boring friends that we need to deal with. They are here to stay. I believe that they are here to stay, even though we have these US actions and the India abolished it and the UK may abolish it. I think we have a clear path ahead for DSTs to be a permanent measure. They are not a good fiscal policy option because they have some particularities that could lead to double taxation. That was my idea of contrasting the European DST with the British DST, which have different nexus rules. And these differences may lead to double tax. And double tax is not good, and we know that. So apart from that, DSTs are quite complex from an operational point of view, and the compliance from taxpayers and also the fiscalization from tax authorities. It's not simple to say that you need to segregate your revenues depending on the type of activity. You may have just one invoice with different activities within one invoice. How to segregate this for a global basis and then for a local basis, and to collect DSTs based on the location of the users, or in the case of the UK, where the users are normally located. So I believe DSTs are not a good option. Pillar 2 is not a good option either because of its complexities and technical difficulties that we all know. So what countries should do? It's a different question. I do not have an answer what countries should do, but I believe that Articles 12B, 12A, or 12AA, apart from the problems that Andrés mentioned at the beginning, are easier to implement from the taxpayer side and the tax authority side than to introduce a DST or Pillar 1. However, a good idea may be that we should look at a multilateral convention on DSTs, or to have some guidances on DSTs, just to stop the fragmentation that we are seeing and these different characteristics that may lead to detrimental effects. That's my idea in a nutshell. I hope it clarified your question.
Anyone have another idea about what has to be done? Andrés.
Yeah, I have a couple of questions, but just to follow, Manuela, your invitation to what has to be done, and before going to more technical things, I've got a couple of remarks here. If you're saying, Leonardo, maybe it is time to have kind of a unified approach to this. So essentially the OECD instilled the virus here, but as Aitor mentioned before, then they discovered that this was not a good idea because they were just going to lose control on this and they wanted to maintain everything under control. Maybe, and more than a question to you, because nobody knows, it's just a question to you and the remaining members in the audience on whether they have also got this rumor. Rumor is it that the possible content of this UN protocol under the new UN framework, which is Protocol 1 on services, might well be kind of a unified, or at least kind of a proposal of a unified universal digital service tax. So, and given the idea that they do not know in the UN actually what to do with this thing they have created, this new framework. I mean, they now apparently have the framework, and they've been discussing on, voting rights and also on apparent logistical things. But now they have it. They have to decide what to put inside, and they just put a name to Protocol 1, which is services, but they don't know actually what they're going to do. So, have you heard any rumor that maybe kind of a harmonized DST might well be the content of this Protocol 1? This is the first question. Second question is related to policy as well. I've been saying, but of course, I've been always wrong with Trump. So every prognosis I've done about Trump proved to be wrong. So this time it might also be the case. But well, forgetting that, I don't really think that any of the technical threats of the Trump administration are serious. I'm not saying that the threats are not serious. They're very serious, but the technical part of the threat is not serious. I mean, if we have people open to say that the European VAT is a custom duty, then they are prepared to say whatever. So are they actually reacting to digital service taxes, or is just one thing or one name that is, kind of very, let's say, very visible? Because of course the big thresholds convert this on a tax essentially on American multinationals. And related to that, wouldn't withholding taxes be a better idea? And I mean, withholding taxes first do not have thresholds, so there is no possible way of saying, well, you are just trying to target the American multinationals, so it covers every service. I mean, from $0.1 to millions. And second, they're kind of silent creators, whereas digital service taxes, it sounds digital service, and then you go to the taxable event, and essentially what you see here is the Facebooks and the Googles and the Amazons of the world, and you see develop online advertising and online intermediation and data sale and all that. Withholding taxes just say services or active services, so they are somehow silent. I mean, I haven't heard so far any threat of the US treaters on the many countries in the world, and Leonardo, yours is one, that already have withholding taxes on services, and they have said nothing. And apparently all services rendered by any service provider that is not a resident is covered by this withholding taxes. So maybe, as far as they don't discover it, because maybe in the future, they
of payment nexus. And I'm not sure if the source of payment nexus is sufficient to tackle the problem that DSTs are trying to tackle. You can have the payment from a different jurisdiction, but your user is located in Brazil, not in Brazil. Brazil is not a good example. Let's say in France. So my question is, would withholding taxes be enough to tackle the issues that DSTs and Pillar 1 are trying to deal with? I believe it's quite problematic when you assume a source of payment nexus. It's not the idea of a DST.
Yeah,
but yeah.
Yeah, but I mean, we are in this vicious circle, and this was created by those people looking for the holy grail of what is source and justifying source taxation. Sorry, Maria Paula, in case you are in this group. I mean, these people try to find a good argument for source countries to go and tax whatever they couldn't tax before. And then they discover all of a sudden this thing that the user created value because all this data that he or she were providing for free had a value, and therefore we arrive at the users, and then we build the whole thing on the users. So we say now withholding taxes are a bad thing because they don't take the user approach into account. But this is going into the vicious circle of the thing in the first place. Because let us think alternatively and say, well, what if the payer and the user are in the same country? Something that might well happen. And that is very common. I mean, in terms of numbers, I haven't seen any kind of empirical study relating to this, but my common sense tells me that many times there is a coincidence between the country of the user and the country of the payer, at least in the advertising world, which is one of the, again, biggest parts of the pie, and there is empirical evidence about that, first. And second, what is so bad about source of payment? I mean, making this question to a Brazilian, I know it might sound kind of strange because it's normally you claiming against the world what is so bad about source of payment. But I mean, there are also good grounds to build all this on source of payment and not getting necessarily into all this kind of, again, vicious circular reasoning. But I see your point. But again, I mean, it's just we don't need to build our arguments with a framework that has already been given to us and from which we cannot go out, because the user logic, of course, is one possible logic, but is not the only one, and also the user logic could be put into question. Come on, which is the value added by raw data? Come on.
Yeah.
Really, is that serious?
I agree, Andres. I agree. I mentioned at the beginning the notion of value creation is highly subjective and highly controversial for providing a nexus for taxation. So I see your point, and I agree that in most of cases the source of payment would be okay. We would be okay with a source of payment. However, they introduced this problem back then. And when we look at Pillar 1 and Pillar 2, we don't have value creation written. We don't have there express reference to value creation. But value creation is still there. And value creation is the source of DSTs. So the problem that we have is a problem of primacy. The premise that we adopted back then, that value creation by users matter in taxing the digital economy. I think the problem is in this nexus that the OECD established during the BEPS project, and inspired DSTs, and DSTs have this as a central idea. But I do agree that the source of payment would be easier, and it might cope with most of the cases. I believe it's Stefania.
Yes, thank you. I think that we're missing very important key players here, because for what Andres just said, I agree with that it's better to create, just like from a payer perspective, that nexus, because these nexus that are created under very good academic ideas are not practical at all. So, for example, key players in all of these digital economy, and not only because I work in such industry, are the payment service providers. The payment service providers are the ones who have all the visibility, who can identify whether we have a local operation where a person
Paying in France is paying to a French company, as Andrés said, that sometimes is local, but also the PSPs have all the visibility to know which transactions are cross-border transactions, are transactions to foreign non-residents. So they have all the visibility, and all these trouble and all these issues trying to get, is there a nexus? Is there a value creation? Is there a location? Because I traveled to Spain and I opened my Tinder app. No, that is, I think that the things are more simpler than sometimes we usually see it from these academic perspectives. And in reality, big techs are very, very familiar with all the DSTs. And basically, the most common way to comply with all these obligations are from this payer perspective. They are not going into whether we have some value creation in some country or something like that. They just go to their numbers, their data, and okay, we have, I don't know, 100,000 customers here, so we're paying DST over that revenue that we have from such payers in such countries. So I think it's also a better approach to have that perspective. And also the withholding tax point, I would like to add that yes, in my perspective, is the best approach to have the full compliance on the DSTs. The issue here is that the tax administrations are not very familiar with this digital economy flow. So when it's the time to designate, to appoint the withholding tax agents, and for example, what has been happening here in Latin America is that the tax administrations point just like different players and different entities that are not even in the payment flow to that non-resident and that foreign entity. So for example, they appoint as withholding tax agents the cards issuers. So that is nonsense in the payment industry. So sometimes the withholding taxes that should be the most effective way to collect any tax, they lack of this effectiveness because we do not have the correct withholding tax agents for this disconnection of the tax administrations from the digital economy. And that's it.
But I have a question, Stefania, for you. I mean, if we are in the B2B context, okay, which is, I mean, that's what the numbers say so far. This is the biggest part of the whole thing today. Let's see what happens in 10 years, but that's what we have today. We have B2B, we have a withholding agent, which is the payer. If you do the withholding correctly, then you deduct the expense. If not, you do not deduct. End of the story. I agree that in the B2C context, things are more complicated. Then you have to enroll other withholding agents, and then we might have more problems and you know, try and enroll the banks and try and enroll all the people. But I mean, this argument in the B2B world doesn't work. And if we are talking about advertising and we're talking about intermediation in B2B context, the payer is the withholding agent. That's it. End of the story.
Yeah, correct.
Right?
It was just from a B2C standpoint.
Okay. That is a different. But again, if we're discussing about DSTs, I mean, DSTs are essentially on B2B. I mean, it looks like this is the biggest concern. I mean, streaming is normally out of all these things, and other clearly B2C things are quite outside all of this. But again, I mean, B2B, it would be just withholding taxes in B2B context would be kind of enough, I would say, in the current situation.
Yeah, completely agree. But also we're seeing that we have B2C digital taxation. So I don't know why are the B2C transactions out of the equation. And sometimes because we know that the biggest flow of funds are in the B2B transactions, But also when we talk about digital service tax, they always have for excellence, and all the tax administrations are talking about B2C transactions as well. They want to get the streaming service. They want to get the content creator payments. So I think that B2C is also part of the conversation of the digital service taxes.
But this is, I mean, in the current situation, this is really small part of the pie. And Leonardo, correct me if I am wrong, but streaming is outside the most DSTs, isn't it?
Yeah, yeah. Even though there are some countries which have streaming tax.
But they are minority so far, aren't they?
In the normal model, the streaming services are out. Streaming service, messaging service, payment service, they are all out of DST, the traditional DST.
Okay.
But there are some countries, I don't recall which ones, but they do have a DST, a traditional DST, and a streaming tax. They have both.
Good luck with the streaming thing. I mean, unless you put a threshold of 750 millions and then you say, well, what we want to tax is Netflix that we know is in. So if they are not paying, then we will pursue them and then sit them in the table and make them negotiate and pay. If you want to have streaming thing with lower thresholds, I mean, it's like, you know, you have a foreign service provider in China, good luck with it. Look for it if you want. I mean, this is the reason for the threshold. Normally, people think that the thresholds are just there to chase the American multinationals. I mean, the thresholds are there just to make sure that you know in advance who has to pay. Theoretically, I mean, we discovered with the British data that you showed before that we can have surprises, but normally, I mean, if you are talking about the really, really, really big ones, I mean, there are no surprises. You know they are in, and if they don't pay, then you call them and you know they will answer because these people answer. They don't want to have problems. I mean, it's like the European VAT with services. I mean, they say, whatever service provider from outside the EU, they must register, blah, 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 blah. Who registered? The big ones. Did the small ones register? No, they didn't. Are they going to register? No, they will not. Why? Because they know there is no way sometimes for the tax authorities to even know they are there. So, I mean, this discussion on the thresholds is quite, I mean, I think it's quite unfocused, I would say, but anyway.
Okay, I don't know if there is any other question or comment. Leonardo, you.
No, I think it was great. I think it was great. Thank you, Manuela, for organizing this, Maria Paula, and Aline as well. I lost my voice, so I don't know if I will have to. I have many meetings by the end of the day, so. But thanks a lot, Andrés, everyone, Stefania, Aitor, for being here. It was a pleasure to discuss. It's a very complex topic, very interesting from a practical perspective, but as well for academic purpose. So thank you very much for everyone.
Thank you, Leonardo. Great presentation, and of course, I knew that actually I wouldn't. I don't know. My role here would be like just to learn, like someone in the audience, not to moderate anything, because you know the content was fantastic, and also the debate. Thank you very much.
Thanks a lot. My pleasure.
Okay, it was certainly a really good discussion. Thanks everyone for coming. We will have another webinar on September, so please be engaged so you can have notice of our new webinar. And see you later. Please share our post and share your comments with us in our social media. Have a
Thank you.
good day.
Manuela, do you have already the
Bye-bye.
date for the September event? No yet. Okay. I will be checking then LinkedIn and so.
Yes.
Bye.
Bye.
Bye,
Thanks.
everyone. Have a nice day.
Thank
Bye-bye.
you so much.
Same. Thank you.